So this video will be a big picture on this chapter and some terminology. As you can see, I will explain to you the difference between economic and regulatory capital, and I will also explain to you the difference between equity and debt capital. So without further ado, let's get started. So let me first explain the difference between economic capital and regulatory capital. In very simple terms, economic capital is estimated based on the bank's own estimates, and regulatory capital, on the other hand, is an explicit requirement by the regulators. And you will see later on in my lessons that credit metrics is the model that is often used when it comes to estimating economic capital, and the vast asset model is that model that is often used to determine regulatory capital. You will learn more about these models in my next lessons. So basically, economic and regulatory capital are both buffers that are based on the risks that banks face. And the banks are facing three major risks, namely credit risk, market risk, and operational risk. And when it comes to credit risk, in simple English, the key question is, will they pay my money back? And when it comes to market risk, the key question is, will my investments lose value? And lastly, when it comes to operational risk, the key question is, can I keep the business running? So basically, when it comes to credit risk, you can think of risks like default risk, downgrade risk, and other types of counterparty risk if you trade in derivatives market. And needless to say, credit risk is of course the most important risk for banks. And when it comes to market risk, you can think of things like interest rate risk, because banks are heavily investing in the bond market, which is sensitive to interest rates. You can think of equity price risk as well, especially if the bank is investing in equities. And you can also think of currency risk, and this is the case if the bank is investing overseas. And when it comes to operational risk, you can think of things like system failure, cyber attacks, litigations, and any other risk that would affect the bank's operational continuity. And the curriculum is also mentioning that when it comes to regulatory capital, the correlations among credit risk, market risk, and operational risk is generally not considered, because the capital for each risk is taken as a simple sum. And when it comes to economic capital, on the other hand, correlations among credit risk, market risk, and operational risk tend to be considered. And the curriculum also elaborated on the difference between equity capital and debt capital, making the point that equity capital is a going concern capital, while debt capital is a gone concern capital. So let me explain to you what is meant by this. Equity capital is basically that capital that keeps the bank going. On the other hand, debt capital is only used when equity capital is gone. And if this is the case, the bank is basically failing. Because equity capital is shareholder money, and of course, shareholders by definition are sharing risk and profit. On the other hand, debt capital is debt holder money, which are not into sharing risk and profit. Instead, they are just simply expecting repayment. So basically, you can think of equity capital as the primary airbag and of debt capital as a last resort airbag. So basically, what is meant by gone concern capital is that it is used when equity capital is gone, which basically means that the bank is about to get gone.